Okay, so very good morning to you once again. Now I'm recording the session. Today, I want to give you a brief introduction of your first assignment. I hope you remember that you have only one assignment, basically, and the second is the exam, right? And I repeat, you can do the assignment either individually or in a group. And if you want to get more details about the dynamics, what should you do, what you shouldn't do, you can go through here. So I think there are a lot of discussion about the instructions of assignment and so on and so forth. I promised you that I will not let you all by yourself, and I will do the assignment one by myself in the context of the British Petroleum, okay? So today, what I have done in the study material, there is a link called spreadsheets. And in the spreadsheets, I have financial ratios, BP, British Petroleum. So you can use this as a template to benchmark your assignment, okay? Once again, I'm no way saying that you should do exactly the same way, but you can at least know the starting point, that what should be your assignment looking like. So that way you can make use of this thing. I also added the second set of slides, which is called topic 2, financial statements and ratio analysis. So technically, topic 2, you can see is here, is basically your backbone of assignment 1. Assignment 1 would be exactly all the theory to do the assignment 1. When I say theory, it means basic ideas. All the core ideas, what should be the formula, how should we do the calculation, how to make the interpretation of it, it all will come from this topic. And that's why I wrote here explicitly that this is the basis of your course assignment, right? So you should be super happy with this set of slides. If you are unhappy with even one of them, please ask, because this can impact how you make the presentation, right? So be careful about this, take this topic very seriously. Let me see. Not many people, only 10 people are in Zoom, right? As I said, this topic is the foundation of your course assignment. So get yourself familiar with this. The topic is very interesting. Financial ratio analysis. I think I told you, I don't know in what context I said some time ago, but I mentioned it explicitly that whenever you go to some agency or a company or a consultancy house containing of financial experts who are doing the deep down analysis and giving some consultancy to the investors to invest, not to invest, divest, whatever to do, disinvest. So all these things, when you want to get some expert advice, when you enter the office, you see two sets of people, one sitting on the right side and the other are sitting on the left side, right? And the one set of people, they don't believe in the history. They said that, hey, whatever is the past performance of the company, bygone is bygone. We don't care what company was doing in the past. We only want to see how the company is likely to perform in the future. And they are the people who never see the company's accounting data. They hate accounting data. They say it's historic. What happened to the company's financial assets last year is last year. We want to be the futuristic. We want to see how the company see itself in the future. And what they see the stock market price. They never see the accounting profits included in the books. Like I told you that see the annual reports of the company, and then you have the annual reports, go to the financial statements, and then check two statements, balance sheet and the income statement. You always look backwards. And I told you in the assignment that you need to go at least 5 years back in the history, right? This is not the way of thinking of the people who believe that. And by the way, these people are called technical analysts. They don't believe in the history. They don't believe in the accounting data. They don't believe in the income statement and blah, blah, blah. They only see that what is the stock price today and what is the likelihood of stock price going in the future. In the near future, in the midterm future, and in the long-term future. They only see the company's growth prospects. They only see the company's future potential. And this, we will not study in this course, this way of thinking. This way of thinking is the financial management course that I run separately. In this course, and as I said before, I repeat, these people who don't believe in the history, they are called technical experts or technical analysts. In this course, you are believing in the history. You belong to those group of analysts who see what has been the last 10 years profitability ratio. What has been the company's debt in the last 5 years? Is it going down? Is it mounting? What are the trends? So in this course, I would force you to become a group of analysts called fundamental analysts. So in this course, management accounting, you would be playing the role of a fundamental analyst. You believe in the history in this course, okay? But when you study financial management or when you study some parts of track, finance and corporate governance, then you would be also having the flavor of technical analyst. Okay, so as a student of finance, you should see both worlds and then decide which one is better. So in this topic, we will be studying financial ratio analysis, which is exactly what the fundamental analysts in KPMG, in E&Y, in Merrill Lynch, they do on daily basis. Financial ratio analysis was very much, it was there in bits and pieces, but it was never a structured discipline until Benjamin Graham, he came in the picture and he made it more structured way of learning, okay? And by the way, Benjamin Graham is the teacher of Warren Buffett. I hope you know this old man. You know Warren Buffett? Have you heard his name? Have you? What do you know about him? What do you know about Warren Buffett? He's a very old man. Sorry? He's the most richest man. But what made him richest? Sorry? He make business. Okay. Yes.
That's the most famous investor.
Can somebody open the door for me? Wait a sec. But close it in a way that it doesn't fully shut. Yeah. Thank you. Close it very gently that it shouldn't shut. So that, yeah. Good. That's fine. Thank you. Yes. What do you know about Warren Buffett?
So he's the most famous investor.
He's the most famous investor in the world. Anything else about him? He's the person who has beaten the markets more than anybody else in the world. You know, we have a market forecast, but he has always, not always, but most of the time, he has overperformed than the rest of the market in the world. And nobody else has done it so far. And if you see his investing mantra, it's very simple. Very simple. He never invests in the fancy stocks. He thinks like this. Hey, what would people do even if they're very poor? Well, they would eat food, okay, invest in the food stocks. They will not give you a lot of money. But when you invest a lot of money, then the accumulate and you keep it doing it, keep recycling it, keep reinvesting it, it adds up. So you need to be patient, right? Okay, people would eat food despite being very poor. Well, people would wear clothes also. All right, invest in the textile sector, right? Which clothes? Will poor people go to some designers shop, or will they buy the common clothes, the very basic? No, very basic clothes. Where would they get it? Well, they can get in some simple store. Like, you don't have to go to some exclusive wardrobe clothing shop. You can just go to, for example, Prisma and buy some basic. Okay, invest in Prisma. This is his way of thinking. Recently, he confessed that he is now regretting why he didn't invest in Apple, because his managers, his assistants went and took the proposal. Would you like, should we invest in Apple? No, never in Apple. I don't like these IT companies. They come and go. But now when he has seen the consistent success of these big IT companies, so he's a little bit repentant that he should have invested in Apple some time ago. But his still mantra is very basic. Just look at those stocks whose demand, now it comes to economics, whose demand always stay, come what may. So invest in the necessities. Necessities are the bare minimum consumption which you would do anyway. Okay, when you are very poor, you will not be living in some villa or in some palatial, in some holiday home, but you would be having some place to live in. Okay, then invest in the construction sector. And those in the auxiliary, because if you're in the construction sector, you also need some furniture. Okay, invest in some furniture companies. This is way of thinking this grand man has. Warren Buffett. So this is the way of thinking financial ratios. Yeah, so as I said that these are the financial ratio analysis is a part of the fundamental analysis. The people who believe in the history, and then there are people who don't believe in the history, technical analysis, that we will not study in this course, maybe in the financial management. Financial analysts analyze the financial statements in the light of, so you see that your income statement, the data is changing, the balance sheet the data is changing. It is because there are some global, national, and sectoral level things happening, and that make an impact on you. Look, when your company's profit goes up, you should give credit to yourself that you are a very efficient CEO. But don't forget, if the product which you make, its demand is going down in the global market, then no matter how good you are, the profits would evaporate. They would go down. So therefore, whenever you look at the historic accounting statement, that not only shows the company's exclusive performance, but that also incorporates the global changes, global economic change, political change, right? Even environmental changes, that incorporates. And then based on this, you can give some advice to your clients who are seeking your expertise, how much to invest, what to invest, and when to invest. In which sector you should invest in which company you should invest in, how much should you invest your whole wealth in one type of companies, or should you invest in a more diversified portfolio? So as a fundamental analyst, you give a lot of advice to your clients, okay? I just took some example of this finance Yahoo thing. I can show you what I want to show you here. If you want to see the global trends and what is going on in the market, then perhaps you can use this as a good example. Please let me know, people in Zoom, if you can't see it, somebody. This is BP, British Petroleum, because that's my case company. And you can see that here, that the price is changing. Every time there's a green light, the price goes up. Every time there's a red line, the price goes down, okay? But you will not see it. You know why? Because in this course, you are not technical analysts. You are the fundamental analyst. This is the stock price. As a fundamental analyst, you don't see the stock price. So this is the job of technical analyst. It just showed up, so I happen to say to you. The point which I want to show you, if you allow me. Okay, profile, maybe this one, financials. You can even get the data, because I always, I have so far been saying you that get the data from the original website, okay? But if you want, you can also get the data from third-party website like Yahoo Finance or Reuters, but I still insist, okay? Not insist, but I still appeal you or suggest to you that another way of learning, another way I want you to learn is that how to go to the corporate websites and how to look at the required annual reports and how to extract the data from them. So that's why. Yes. Yes, go ahead. In which house? In the stock market. Yeah, exactly. Yeah. Yes. Yeah. So based on whether you are a technical analyst or a fundamental analyst, if I'm running this investment company or a hedge fund, and I divide you in two groups, fundamental analyst and technical analyst, at the end of the day, I combine both information and make an overall story, okay? And then you are in a position to give the recommendations to the investors. Like, for example, in Yahoo Finance, you can see here that the data is from last year, November, December, and January. I hope you can see it. Can you see it? Or should I zoom in? Look at these colored bars. And you can see here that there have been, how many people in January? February data would be available next month. So 28 plus 10, 38, 51, and 54. There are 54 opinions of analysts. And these are not startup type of companies. These are the biggest investment houses, private equity funds. They are the one who are giving these suggestions. And guess what? There is a dark green strong buy. So this analyst has combined the opinion of technical analyst and the fundamental analyst. And what he's suggesting in January, hey, wherever you find BP, just get it, just buy it. And look at the tone. The tone is that the person is giving you a very strong recommendation that buy BP. And then there's a light green, 10 people, 10 companies, 10 analysts, and they are saying buy BP. Can you see the difference in the tone? Yeah, but overall, they are saying the same thing. 38 people, they are saying that, you know what? 16, yeah. So this is altogether 28. So this is 3 plus 13, yeah, 3 plus 10, yeah, plus there's another one, and then, yeah. So overall, if you can see that, if you add up the dark green and the light green, these are the people who are giving suggestion based on the combined analysis of fundamental analysis and the technical analysis. And what are they saying? They're saying buy BP. Why would somebody suggest to you that, hey, buy BP or buy this stock? What could be the principles behind it? If somebody's telling you buy a house now, for example, or buy this product now, what would be the underlying principle behind that? Yes, sir.
If they have something to gain, and they own the stock themselves, or that product.
Mm-hmm.
So if many people buy stock as well, the stock price will go up and he will profit.
So do you believe that when you're suggesting this thing, people would buy, the price will go up? Yeah. Okay.
And if the one that's just suggesting buy the stock, if it's someone who has a lot of influence,
Mm-hmm.
then yeah, but I don't think that like random individual people that you see like on Yahoo Finance that recommend to buy stock. I don't think that those people matter that much.
Okay.
But then when you see like some banks, you know, when they up like the recommendation or like the target price,
Mm-hmm.
that will make a difference.
Okay.
Because people trust those more.
Yeah, yes, fine. It's okay. But these are very trustworthy people. Remember, Yahoo Finance is a free website, okay? And they also give you the information they don't give you the real-time data. Of course, but if you approach some bank, as you said, or if you approach some financial analyst, they have the real-time data. So we assume that you are a client and you approach your financial advisor, consultant. What do you think about BP? And then they are saying, you know what, buy BP. In my opinion, or in a simple opinion, somebody would suggest you to buy something for two reasons. Number one, its price is cheaper now. So there is a target price, as you said, there is a theoretical price, and then there's a real price, the actual price. The actual price is below the target price. In other words, the market is treating this stock unfavorably. The price deserves to be more, but the price is low. But the company is good enough. Once soon things will get better and the price trend will go up. And eventually the market price would be equal to target price or even exceed that. So basically you are giving a suggestion to somebody, hey, you want to buy a jacket, you've been looking for it. I saw in the market that the tag price was 150 euros, but actually it's selling at 78 euros. And if that jacket is still in fashion and the quality is still good and you still like it, what would you do? You would consider to buy it. This is exactly the same way of thinking that you see the price to earning ratio of a stock. I haven't explained price to earning ratio yet, so I will not speak the technical jargons. But the idea is that you are comparing the company's actual performance with what the company deserves to get. And if there are some group of people who are saying that, you know what, and by the way, these are not random people, these are really expert in their fields, and they are saying that buy. It means the underlying philosophy is that the stock is trading at below what it should be. So therefore, soon the market would be correcting itself, hopefully. So there's a risk. It may not correct, but there is an argument that the price should be 20, the price is 10. Buy it, and when it becomes 20 and above, then sell it. That's the underlying philosophy, right? I'll come back to you. And then there is another yellow people. And they are saying what? Hold it. Now, what does it hold mean? Hold means if you have BP, don't sell it. You get my point? Hold mean if you have it, keep it with you. Isn't this yellow opinion matching with the green opinion? Green are saying buy it. and yellow are saying, if you have it, don't sell it. If you see the combined opinion, they both are saying that either buy BP, or if you have it, don't sell it, keep it with you. What information, what does it hint? It hints that the price can rise in the future. Okay, and you can see there's a very small and underperform, yeah, sell. There's a very small minority. In fact, there's nobody in the month of January. There were some people in November and December last year, but in January, there's no red box. So nobody is saying sell. It means this opinion is in the market for the last couple of months. If you look at November to January, you will see that the opinion is more or less same, that buy BP, or if you have BP, don't sell it. And those who are saying that sell it, they are a very small fraction. So the overwhelming opinion of the market analyst is that BP is more likely to grow in the future. Okay. Yeah. So you have some questions.
My question was, is it important to have a homogeneous growth like the fundamental analysis mostly? They look at the background, the history of EPS. So if the EPS has grown and in a not up and down way, like homogeneous growth, they are going to be increased a little bit. So these things show that the business is growing in a reasonable way, and also it's a good business to invest.
Yeah.
So if the EPS just going up and down, so it shows that something is wrong.
Yeah. Not wrong. It depends upon what time frame are you saying. If you look that the last couple of years have not been good for the global economy. We know that since early 2020, the market is in very bad shape because of COVID-19, and now we have this war thing. So basically, some of the external factors. Now, if you are analyzing the EPS, for example, for the last 3 years, it will show lots of fluctuation or very steep downward trend, okay? But if you look for the last 20 years, then these 3 years would be merged in the overall picture. You see my point? It's like, I can show you here, even though I was thinking not to show at all the stock price. If you look at, if you look at one last month, if you see from January to January 30, February 10, the price is going up, right? So when you look at the monthly, 1 month, month-to-month data, you may tend to believe that the trend is going upwards, okay? Because your time horizon is 1 month. But if I make it to 6 months, then the trend can change. And if I change it to last 5 years, then the whole idea has changed. So depending upon time frame, as a fundamental analyst, or even as a technical analyst, you need to ask yourself, or also ask your client, what is the time window your client is interested in? Look, I can come as a client and I can ask you, hey, you're my financial analyst, I want your advice. When you start probing me, when you start asking me, what is my wish list, which company, what type of stock I'm interested in, you will also ask me one thing, that how much time you want to stick with this investment. Are you investing it for 3 months? Are you investing for 3 years? So then I would give you my, that I think I want to stay with this investment for 3 years. After 3 years, I would recycle the whole investment. I remember, I will not name it. There's a one very famous, famous, what can be famous in this small city, but there is there's an investment company in Uvascular. And we worked in a project 2 years ago. Actually, we worked for 2 consecutive years. And so 7 and 7. So I had 14 students who are trained there. They had a very interesting way of investment. They would only invest on behalf of City of Uvascular. So their big client, who would give them about 95% business, would be City of Uvascular, Kaupunki. And look, and their total investment was about, the overall portfolio was about 30 million euro. But they had a simple, straightforward philosophy. They would only invest in startups and SMEs. Not the listed companies, but only small companies, small and medium enterprises. And then after 7 years, they would totally recycle. So they would say goodbye to those companies, and then they would invest in the new company. So their time window was 7 years. And why I was having project with them last year and the previous year, and why not this year? Because last year was the 7th year. So they were looking for new companies where they should invest in. And how I was involved, because they asked me, Shab, can you send some student of your finance who can find us that which are the new companies, we give you some name of companies, you guys get the data, you guys explore it, do the ratios and stuff, and tell us which should be the new set of companies we should go for. So yes, the time frame is very important. I asked them so many times that why you recycle after 7 years. They will say it's our company philosophy, we can't change it. So we know sometimes we suffer loss. We repent why we sold after 7 years, because the company is still making success. But this is our philosophy. So when you ask your clients who approach you, you also ask them one important question: what is your time window, time horizon of investment? And then you make a suggestion accordingly. Yeah. All right. Yeah. Financial ratio, as I said, is a subset of fundamental analysis. It required deeper analysis. I think I said before, financial ratio analysis is like a health check, is like a diagnostic check. And you check the health based on these parameters. If you want to check that if a certain company or certain industry or certain sector is doing well or not doing well, then what you do the financial ratio analysis. And then you conclude if the company is doing good or bad. It's like a diagnosis. It's like a financial diagnosis you do. That's why I call the financial ratio analysis as a diagnostic test, because you have 4 types of health checks. The first health check is you check the company's liquidity, you check the company's solvency, profitability, and its operating performance. And then based on these 4 different types of health checks, you conclude if this company is doing good, or maybe doing good in this, but not doing so good in that, what can be done and how you can do it. This is why I focused on that when you do the financial ratio analysis, even if your answer is accurate up to 5th decimal point, you will not get full marks. Because then when you calculate the ratio, what is your next job? To find out, is this ratio good or bad? If it is good, how you can strengthen it further? And what should you do that you make it even stronger? And here comes the inference, the interpretation. And if it is doing not so good or bad, you need to know that, okay, this is the ratio and this is what it should be. What can be done that this ratio, which is not so healthy at the moment, can become better in the near future? What type of measures the board of directors should take? What type of operation you should change? So all the nuances which are related to make this ratio look healthy again. That all is included in the inferences. Okay, so therefore, it's very important that you don't confine yourself to the numbers alone and go a step forward and make the proper interpretations and the inferences. Yeah, just gently, yeah, so that it doesn't shut down. Okay, you have to, yeah. Okay, now it's good. Thank you. And the data which you require will come from the income statement, balance sheet, sometimes cash flows, but I would say that we can live without cash flows in this course. So that is why I emboldened income statement and balance sheet only. So bulk of your data would be coming from these two statements. You choose a company, you look at these two statements for the last 5-6 years, and that's it. That's all you need to do. And there are many users of financial ratio analysis, investors, analysts, corporate managers, students, of course, researchers. When I was doing my PhD, I was looking at the financial ratios so extensively of my case companies. Yeah, regulators, controllers, internal. So anyways, I don't want to explain the meaning of these, who these stakeholders are at this moment, unless you have interest. But there are many stakeholders. There are many people who are interested in the financial ratio analysis, even the employees. I mean, imagine I'm planning to join a company, right? And I'm interested in finance. I look their ratios of debt, and I find that this company is neck deep in debt. Their operational performance, they have a good name, people like them, but if I see last 5 years performance, I find that the company's operating performance is dismal, the debt is mounting, the company's profitability is a dream now, they have been in a very bad situation. I would think twice, should I join this company or not? You see my point? So even as employee, sometimes you're interested in, if you're offered a job, you will be interested in knowing their financial strength. Can they even pay you a salary? So be careful about it. And the objectives. But anyway, I'll quickly want to come to the mindset is very important. You come with the mindset of skepticism. You are thinking critically. And I hope in all the courses which you study in IB, one explicit focus is on the critical perspective. Critical perspective is not same as the criticism. Critical perspective is that you are not taking the information as it comes. You analyze it, you process it, you filter it, and then you make an informed decision based thereon. So you always take the information with a pinch of salt. Don't trust. I think I told you before that these corporate executives, they wear nice suit. They speak fantastic English. They are very good looking, very excellent, impressive personality. But that doesn't mean that everything they're saying is truth. Okay, so take the information with a pinch of salt, filter the information, be nice to them. Okay, smile. They're smiling all the time. You also smile. But then at the end of the day, see, I want to see your data and I want to analyze it by myself. And then you decide whether you want to analyze as a fundamental analyst, looking into the history, or you want to scan them through the stock market as a technical analyst, or both. Then you say that, hey, you know what? We met yesterday and I like your company, you're doing a great job, but I saw that your debt ratio is growing about 30% a year. Why are you borrowing so much? And how would you repay? And I've been seeing that your net profit is your revenue is increasing, but your operating profit is going so badly. What's wrong with your cost? Why your cost is rising so much? Where is your operational efficiency? Believe me, they will stop smiling. So therefore, it's very important that you also analyze the information. And I'm not talking about the small companies. Here I'm talking about the big companies, the billion-dollar worth companies. They lie. They do lie. So therefore, you have to detect. So what I'm saying is that you're not paparazzi, you're not the spies, but at the same time, don't believe everything they say or write. So this is very important that you see it from a very critical mindset. This what you say, the lens of skepticism. So you don't see, unless you test the information by yourself, you don't believe it. Okay. This is some additional information. I'll come back to it later on, but I want to quickly take you to the mindset. Once again, is very important. Mindset, interpretation, and inferences are very important. Look at this company, for example. This company. Now here I want to tell you what financial ratio doesn't tell. So this is why the story is very important. You see those two words apart from calculation, interpretation and inference. They're very important. Now look at this. 3 years, 2012, 13, 14, this company had a net profit of 50,000, double. So every year the profit is doubling. And every year the investment in the company is also doubling from 500 to 1 million, 500,000 to 1 million to 2 million. Now, if you look at their return on investment or return on capital employed, if I divide this by this, it comes to 10%. If I divide this by this, it comes to 10%. And if I divide 200,000 by 2 million, it comes to be 10%. So when you see the ratios, as calculation, it looks that the company is very static. Every year, the company is giving 10%, 10%, 10% growth rate. All right, 10% itself is quite a good growth rate, but there's no change. There is no dynamic. The growth rate is very constant. So then you can ask yourself, is the company not growing at all? But when you look at, okay, based on your calculation, you conclude that the company's return on capital employed is constant. But when you draw the inference, when you make the interpretation, you find that, look, hey, we forgot one thing. The company's profits are doubling each year. The company's investment is doubling each year. Therefore, the company is really making a mark for itself in the market. The company is really growing fast. I mean, look at the profits are doubling, capital is doubling. It shows that the company sees a massive growth potential. Only then the company would invest so much. So despite this growth rate to be 10%, it doesn't matter now. Even though it's 10, 10, 10, there's no growth. But when you see the larger picture of the company, there's a massive growth. A company is growing double each year. This is what it comes to narrative. This is what it comes to the word I used, inference. Yeah, you can say it this way, that calculation alone is not enough to make a conclusion. If you only make a conclusion based on quantitative numbers, 10%, you will say that the company is stagnant. But when you see the items, the numbers who appear in this calculation, you find that it seems that the company is doubling each year. How is it possible that the company is getting double growth and we conclude that the company is stagnant? On the other hand, it can also happen. Let me show you now. It's very intriguing. Why Why it's taking so much time? On the other hand, it can happen. Let me see. Is anybody on Zoom can check that if you can see the Excel empty spreadsheet? Can you see it? Or anybody can confirm who's in
Yes,
Zoom?
I can see. I
You
can
can't
see.
Okay.
I can see, sir.
All right. Now I'll share it. Now it's visible.
Yes, sir.
Okay, good. Now look at the situation. There's a company, and these are its profits. And this is the capital employed. And the year are here. Hmm. Sorry? Ah, okay. Have a look at this. Now we calculate return on capital. What I'm saying is that even the ratios can be deceptive sometimes. So you have to see the overall story. Return on capital employed, ROCE. And the formula is the profits which company earns divided by the capital. If I format cells and I make it percentage to 3 decimal points, yeah. Look, this is why the pinch of salt is very important. And this is why we need to go beyond calculation. And we also need to see the overall story, which we cook up. Look at this company. The company is growing. ROCE, return on capital, is 10%, about 11%, and 17.5%. Based on calculation, this company looks so healthy. But if you look at the capital and the profitability, the company is like a melting glacier. In 3 years, the company has lost its size by 2.5 times. So company is melting pot. Who knows, in 2023, the company's capital becomes 0. But when you look at the ratios, they look very nice. And believe me, this is exactly what looks to the companies, those who have become bankrupt. You know, there has been some titans who fell in the last 12 years. 2001 and 2002 were the year of bankruptcies. The major companies became bankrupt during those years. Hundreds of companies in the USA, they just fell like a pack of cards. And many of them were massive companies listed in the New York Stock Exchange. And believe me, until the moment of the death, the ratios were very good looking. Because there were not enough people who could go beyond calculation and see the larger picture. You as a fundamental analyst, whenever you see the healthier ratio or a going down, poor ratio, don't jump to conclusion unless you see the bigger picture. Now I can give you one more example here. If I copy and paste the same thing here. Right. There's one more company. Okay, now if I extend this to here. If you look at the return on capital employed, the company's performance is really going down, isn't it? But when you look at the company's growth, the company is growing. Why would somebody invest in company's equity in capital unless you have a faith in the future? Of course, when you increase the size of the company, there would be some problems in the beginning. It could be that your profit figure goes down. But then eventually you believe in the company's future. And you believe that the company, okay, in the initial phase of restructuring, of growing size, the cost may go up. There can be a lot of fixed investments. So as a result, your profits can go down in the short period. But look at the overall size of the company. In 2 years, the company has gained 50% growth in its overall size. Okay, now question is, whether you believe in this or whether you want to see the larger picture and you are happy with, I mean, here you were unhappy with the growing ratios, but here you're happy with the falling ratios, depending upon who you are. If you are a short-term investor, if your love affair with the company is for short period, then you are more concerned about the ratios and their calculated ratio. But if you are going to live with the company, this alliance is going to stay for a relatively longer period. Then you not only see the numbers, but you also see the overall picture of the company. So as a short-term investor, you are more concerned with the calculated numerical figures. But as a long-term investor, you are more concerned about the company's overall story, right? So one question, when somebody approaches you and seek your advice that should I invest in this company or shouldn't I? Then apart from asking this thing, that how long, actually this question that how long is your investment horizon fully fits in this calculation. If an investor say, I'm a short-term investor, maybe I invest in this portfolio for only 2 months, 3 months, all right, then you don't tell him, but you believe intuitively that my client is more concerned about the good-looking numbers. But if you come to know from the conversation that this client would stay in this portfolio for longer period, then you can take the liberty and you can see that, you know what, even if the ratios, these numbers are going down, but I think my client is more interested in the bigger picture, in the grand narrative of the company, rather than just the numeric figures. So therefore, this data speaks, these numbers speak. You see, from this numbers, you can create a story, you make the interpretation, and then you take a decision and inference, and then you tell your client, I think this company fits more as per your profile. If this is the company, all right, and you're a short-term investor, you know that, you know what, this client would be disappointed based on these numbers, okay? And then say, oh, I think you should invest in this company. But on the opposite, if the investor is a growth-based investor, the investor believes in the growth of the company, then perhaps this company is more recommended for this type of client. So you have to be very client-oriented when you give the advice, okay? The question is that not all of you would be working in the hedge funds or private equity firms. What if you are not even in the finance field, you are a startup entrepreneur, but you still have to do some calculations. You still need to know some calculations, and you are planning to invest in a project, and the project would go for a long-term basis. It's a long-term project. Then you go for this type of mindset. On the other hand, you are going to invest in some IT system which would not last for more than a year, then perhaps you have to look at this type of mindset. So even though you are not strictly in the field of finance and you are purely an entrepreneur who knows bits of everything, okay, then you may still use these financial ratio analysis, right? All right, there's something in the chat. All right, good. You can see it, that's great. And now I go back to the screen. The first ratio, the first category of ratios that we need to calculate is the operating ratios. But as I said before, that today I'll have a short meeting with you, okay? So these ratios we'll start calculating when we meet next week. Do we meet next week actually? No, next week is the holiday week, yeah? But I would recommend you one thing, that when we meet the week after the break, yeah, it's a good idea that you are slightly, just a sec, you are familiar with this spreadsheet. Very quickly, I want to tell you something. If you open this spreadsheet, where is it? Yeah. My friends in Zoom, can you see this spreadsheet? A lot of numbers there.
Yes, sir, we can see it. Yes, sir, we can see it.
You can see it? Good. Okay. Now you can see here, when you make this spreadsheet, you will write down the financial ratio analysis of your case company, yeah? And then you write down the names of your team as well in the first sheet. And then you write down the types, and here are the types. Okay, so what I get the data. Well, you know what, don't get frightened, because I took last 12 years to analyze British Petroleum, but you only require 5 or 6 years, okay? But this is the data which you will be interested in getting. So unless you get these data, this is why I call it input data. Input data means what you need to, what absolute numbers, like in this spreadsheet, profits and capital was the input data, and the return on capital employed was the output data. So same way, you need to get some input data by yourself to calculate this ratio. And because I made this spreadsheet last few years ago, so 2019 is there, but I think your latest year should be 2021 or 22, depending upon when the report is published. Even if your latest year is 21, no problem at all. And then you start getting what type of data you require here. And then you have another set of ratio, liquidity ratio. And here also we have the input data. In some ratios, your input data would be same, okay? So you don't need to calculate it again. Solvency ratio and the profitability ratio. So the message I'm trying to give you here is that this is a complete financial health check of British Petroleum, which I made in the year 2020. And the health check I did, we have different type of therapies. There is something called allopathy and something is called homeopathy. Okay, so that makes the difference whether you want to give the treatment as a diagnosis as a technical analyst or a fundamental analyst. Here I chose to be the fundamental analyst, but I applied 4 health checks: operating ratios, liquidity ratios, solvency ratios, profitability ratio. Now, what these ratios are, they all are mentioned. So you can see the first set, operating ratios, yeah. The second set of ratios, liquidity ratios, second health check. So the theory is given here, right? theory formulation is given here. The next health check was solvency ratios. Yeah. And the final health check was, what was the fourth one? Yeah, profitability. Yeah, they are same. So all 4 health checks are done here in the slides. I would think if I would touch this last D health check or not, but we'll see. We'll see how let's see how things takes place. But focus on. So you can link. You can because now I assume that you have chosen your case company. You have made the groups. So start collecting the input data already, right? And the template is available in the Moodle. So what else we need? Well, we just need to do some hard work and do it sooner, okay? And one word of caution I want to give you, and I don't think it will be a surprise to you also, that different companies, they may use different phrases for these expressions. So not all the companies CEOs have taken their management accounting course in Young. So they might be using different expression, different phrases. I tried my best to give you a list of synonyms, okay? But there might be still some words, because there are thousands of companies, listed companies in the world, tens of thousands rather. So I can't really teach every accountant. So it could be possible that they might be using some different expression, okay? Search for the synonyms. And if you don't still not convinced, ask me, either in person or in the discussion forum, all right? But my suggestion is that even if you are not yet been able to calculate the ratios, at least start building up the input data for all of these ratios, right? And as I said, some of these numbers, some of these variables or data would be common. Like assets would be used in many types of ratios. Operating profit would be used. So yeah, so it shouldn't be a big problem for you. I'm very optimistic that you will do it very well. Right. So now I end the lesson because, as I said, I have an overlapping meeting today. So we will not be meeting next week, but you have a lot to do. Yeah. So wish you all the best. Have a great holiday week, right? Work too hard, but don't work too hard either. So we'll be meeting in 2 weeks' time. And then we shall have, I would spend maybe 1 or 2 less sessions on this ratio, and then we move on to the next topic, okay? But I'm not in a rush. I want that we do things here. So the best part is that when you come the week, in 2 weeks' time, bring your computers, have your input data, calculate in front of me, so that if you have any problem, I can help you then and there, right? See you in 2 weeks' time. And goodbye, my Zoom friends. See you soon. Mohammed, quickly ask me the question.
Sir,
go for
yes,
a meeting.
just want to know, like, is it going to
The
be
problem
uploaded on
is
the
that I
Moodle,
can't
the
hear you.
recording?
Just a second. Let me.
So just want to know, like, the lectures recording is going to be uploaded on the Moodle as well?
Can you speak now?
I just want to know that the lectures is the recording is going to be uploaded on the Moodle.
Sorry, recording what?
It's going to be uploaded on the Moodle.
Yeah, that's what I
Okay,
normally
sure.
do. If I record something, I would share with you. Otherwise, I will not record.
We have no lecture.
Next week is the holiday week, right? So we meet in 2 weeks. Yeah. Happy holidays. So so I am recording it, so I would be sharing the recording, okay?
Sure, thanks a lot, sir.
Thank you very much. And enjoy the holiday break.